Welcome to the new issue of the Grey Market Talk with former, almost not so retired market maker for options. I'll talk about volatility later. And god of investment strategies, portfolios, and chief investment officer extraordinaire, Nic I. Hello, Nic. Thank you for your time again.
You're welcome. Hello.
It's going to be an interesting one this week. I've prepared a little slide deck, and we deliberately spared out the Bank of Japan, because as we are both on holiday next week, I still want to have something on the channel for next Sunday, and we will look into the plumbing of capital flows. And who would be better to explain us the intricacies of that than you? So everybody who's listening in now, yes, we will be out next Sunday, even though we're on holidays, and we will get a little bit more into the details how capital flows actually work. I might have a lot of questions because that's not my field of expertise, and I'm hoping that Nic will school me again how things really work, that I can adjust my wrong opinions about markets. So I've prepared a beautiful slide deck, Nic. And oh, by the way, before we start, we spoke about Nigel Farage last week. Exciting developments over there, aren't they?
Absolutely. And I think, without being political about this thing, what happened to the management is almost certainly the right thing.
I saw that. Alison Rose, and I had to look up the other guy, Peter Flavel from Coutts. What I found interesting is actually each of us would have been sacked on the spot if we would have ever disclosed client information. And how the media was portraying it. Yeah, she made an error of judgment. Alison Rose, that is, from NetWest. Sorry. If that is the excuse, yeah, nothing illegal done here, move along, an error of judgment. Oh, yeah, fine. I didn't error. I was really surprised, but it looks like Nigel Farage actually got the wheel in motion and almost made me believe that bankers, we are evil, Nic, aren't we?
Well, obviously in places, I must say, I do know some very good bankers.
Good. Fine. Let's get up the slide deck. Let me see. I have it as a PowerPoint presentation. I shall attempt to share my screen. Zoom. No, where is it? Well, that's very interesting.
Okay.
Share button seems to have disappeared. Show captions, poll. We could do a quiz. It offers me this. Where do I have more? This is really weird. Share screen. Found it. There we go. You tell me if you can see it.
Certainly.
Okay, quite interesting slides on the 30th of July, 2023. 3 points we want to look in today. Macro, European Union, and the United States. Obviously, want to have a look at Germany. Then volatility, because there are interesting things happening at the moment. Even if you're wrong about the market, which I tend to be a lot of the time, if you work with a proper toolkit, volatility, you might be able to do interesting things. And then I wanted to, well, jump on you with asset allocation, obviously, because I read an interesting article I come to later, which is directly your toolkit, your know-how, where you can give us an idea. So let's start with it. Meme of the week. Deutschland 2035. I laughed my head off when I saw that. It's a brilliant forecast of what's going on at the moment in Germany. There was an interview out with Mr. Habeck, our Minister for Economics, Bundeswirtschaftsminister, and it wasn't widely distributed, but it was very interesting. He said, obviously, we have a problem with electricity in Germany, especially electricity price, and electricity prices for the industry out there. And he said he sees the danger in that, but the cabinet hasn't quite decided about something he's supporting very strongly, that there will be a special electricity price for the industry in Germany. And then he said in the next sentence, obviously, we don't have the money to do that, so we have to do something which we invented in Germany, a Sondervermögen. Nic, is there a translation for Sondervermögen?
Not that I know of. These are very special German words.
What is special? I try to translate it. What it means is it's a special pot of gold, but that isn't really there because you had to take in huge amount of debt to create this, and we simply call it different. It is debt, but we call it an asset. So we've done that for the Bundeswehr, for the German army, with 100 billion. Then we have done it during Corona with another 100 or 200 billion, and now they're talking about fixing something up like that, and the finance minister still has trouble in that because it means increasing the debt of Germany again. And the numbers I read to actually do that thoroughly, to provide German industry with energy prices which are competitive, it would be in the region of around 300 billion. So suddenly we start talking about serious money here. And what he said is, yes, the cabinet is still discussing it, even though he's preferring that because he sees the danger. And then the sentence, that's maybe why it wasn't distributed all over or plastered all over the media. He said, well, if we don't have that, then we don't have an industry anymore in Germany.
Oh, there you go.
Which now, is quite...
Is this capex or subsidy?
Subsidies. Not capex. They're just subsidizing electricity consumption in the German industry because the prices used to be around 3 to 4 cents for kilowatt stunde. Privates pay at the moment, we are capped, you and I, Nick, at 40 cents, yeah? Like the price of an ice cream cone, a small one, per kilowatt stunde. It's ridiculous, but that is where we are at the moment. And I thought, if this guy already says, well, if we can't go out and increase our debt burden massively, we will not have industry. And that's obviously when the memes showed up, and you see these guys here. Yes, they have a house and they have solar panels and they're watching the state television and they have a, how do you call that? A Lastenbike, a carry bike, and a special ventilator. Wärmepumpe is the German word for it, heat exchange system. But I wouldn't really want to live like this. Yeah? So I thought, yeah, let's have a look at Europe a little bit closer, because that also feeds a bit. You're schooling me now for weeks why I'm wrong with the US economy. And I'm still desperately looking for the reason why that could be the case. And this was, well, my aim today to get into this. And I think that is Citigroup again, or Citibank, the economy surprise index. And I found that very interesting, what we're seeing here. Yes, US keeps on surprising us over and over again. Maybe you can say a few words to last week's figures in a moment. And the Eurozone economic surprise index, not for me surprising at all, because I live here, I speak to entrepreneurs, and we have the German Mittelstand, the middle class, which is really pulling the wagon for employment, growth, everything is drifting into a right old pickle here. Nick, US economic surprise index. What's happening there in the US? We saw the figures both, what happened last week. And for me, every time, it's a big, big surprise what's happening there.
Yeah. What can I say? Firstly, everyone's expected this recession, right? So everyone's got that wrong. Totally wrong. Yep. Everyone looks at Germany and says Germany is, definitely not strong. It's got its own problems, but yet both markets go up. One market goes up because potentially that they see a trend of growth, and for the first time, the Federal Reserve even say we don't expect a recession. They said recession last year, so you're supposed to believe them, of course, this year. But so that market's gone up, but nevertheless, the European markets, which are, or the European economies, which are really awful, the stock market's also going up. So it just goes to show, if you want to trade and invest in the markets, you really got to think a little bit differently. But, realistically, the US is not, it's not in awful shape. And the US did put a lot of money into the system after COVID or because of COVID. And that money is still sloshing around. And obviously, they've got this privilege with the dollar to just increase the debts, without any problem whatsoever. But obviously, the Europeans have to think twice about it. So they're a little bit on the back foot. And that's obviously, shows the advantage of the US versus other economies right now.
I have an interesting slide for an explanation for that later, which I found very interesting because, well, what we're talking about is about the debt levels we can see here. And that is a slide in front of us is now the so-called Maastricht debt level. Yeah, when they were selling us the euro, everybody had to promise, oh yeah, we are not spending more than, I think it was 55% or something of our GDP. And what we can see here in front of us, obviously Greece, Italy, Spain, France, Portugal, Belgium. I think it's pretty much hopeless that they will ever recover. So we're getting heavier and heavier and heavier into debt. And Germany, right here in the middle, they will eventually also go beyond the Maastricht debt limit we have in here. So there is an enormous pile of debt being built in. And we had this conversation last week where you said, yes, the rescue would be CapEx spending, what socialists always do in their final hooray, which could boost the market up again.
Yeah, I mean, actually, the social thing is what they just offered, or Hubex just offered, with a subsidy as opposed to CapEx, right? Mm-hmm. So he's not talking about investing something for the future, where you say, if I lend you money and you invest it, that investment will yield something which will repay the debt. The moment you go down subsidy route, it is, hoping to, it's kind of bribing people to stay in Germany at the end of the day. And there's a big question mark whether that's good for the long term. Whether that's the right long-term solution for this thing. Does this include the Sondervermögen, by the way, for Germany?
That is a good question. I can't tell you. I don't know that.
But it just goes to show, if you're trying to sort of behave within the Maastricht limits, it's not been good for you. I mean, look at what the Americans are doing. They have not had a surplus for absolutely years, for 20 years or so. And you look 20 years from now, they will not have a surplus. So for them, their growth is based on the privilege that they can continue to borrow, continue to invest in their economy, and they know that the currency is not going to fall apart. But I don't think really any other economy can behave that way.
I'm always careful with these long-term forecasts you just made, because I remember when I went to university, on the Spiegel, on every newspaper in Germany was America is finished. Can't do anything. And then Bill Clinton, a couple of years, came in, and suddenly America was producing surpluses, which nobody expected. And when I just started in banking, was even the discussion, oh yeah, what's the world going to do if there are no US government bonds anymore, because the United States doesn't need money? Big conversation. Well, it looks a bit different now with 33 trillion in debt now.
It's almost 33. It's 32.6 on the official clock, I think. But when you look at the underlying breakdown of where the money is going to get spent, look at the Congressional Budget Office thing. They keep updating the numbers now. Monthly. You can see the places where they are going to spend the money, on social welfare, Medicare, and defense, and now interest payments. Interest payments will far exceed some of the other things that they're spending money on going forward. You really got to wonder, well, where is the money going to come from? And it's not going to come from tax. So they do not tax. They do not increase any tax since COVID. COVID was not financed by tax. COVID was financed by spending more money.
Yeah, well,
sorry.
I beg to differ there again, because yes, normally nobody's increasing taxes, but all this government regulation that comes in, is taxed by a different name. They're telling you what heating system you must have at home, how your insulation has to be, what cars you can drive. This is just increasing the costs for all individuals, for all corporations out there. Yes, the nominal tax rate stays the same, but the state becomes a bigger and bigger taker or inducer of additional costs. And I don't care how they call these costs. There could be taxes or administrative fees or whatever. It's still increasing, and we never see that in official statistics.
Well, for me, that's a kind of an inflation as well, because you, in order to exist in an economy, there somebody is saying you're going to have to spend more money, and that for me means that if my costs go up, there's got to be that's an inflation. Yeah. But who's paying for this inflation? You could argue, well, the people have paid for it over the last couple of years, but partly that's been due to the money that they've been given as a result of some of the post-COVID handouts. But in the end, who's paying for it? So the moment that the Federal Reserve or the ECB or whoever puts the interest rates up, the people who pay for it are the governments, of course, plus the people who have leveraged, like private equity and all of these other guys. But you imagine when the interest rates go up, in order to solve the problem of inflation, it's the bill goes back to the government. So the buck stops with the government, and that's really where we have to say, that's where we need to think about all of these things. And you said to me many times, so my only thesis is that the system can't stop, i.e. the things can't go down, because otherwise we're all toast. And that's absolutely right. I mean, the moment the government are the last kind of check in all of this thing, then it just can't break down at all.
Isn't that the proverbial black swan? They don't want it, and they try to facilitate it for it. And at one stage, you will simply get overwhelmed, and all their powder has already been spent. There's no dry ammunition anymore, and we fall into a deep hole. And that is actually the next slide, which I think was the biggie this week coming out. The IMF forecasts for, well, how would you want to call that? Important states who have industrial production and should be part of the future development of the world, we can see here. And it's absolutely abysmal. If you look, Germany, whoever's just listening to that while doing something else, which you shouldn't, Germany forecast minus 0.3% in growth by the IMF. And if you look, India is at the top, China is at the top, United States plus 1.8, surprising again nicely. Russia, whom apparently we're going to bring to the knees, plus 1.5%. Japan is doing well. Even Italy is doing well, plus 1.1%. Only Germany is one of the big industrial nations, one of the biggest still on the planet, which has negative forecasts. Riddle me this when I look at the German equity market.
Yeah, absolutely. I mean, we have to sort of divide the two, but, you know, from the thing that we're not really here to discuss, the political side, when you run an economy based on ideological decisions as opposed to decisions which are good for the people that vote you in, that's what you get, basically. And you know, the debate we had last week about Brexit, good idea, bad idea, when you look at stories like this, it's very clear. The future of the world, and we've always sort of known this, is the emerging markets, it's Asia, and it's certainly not Europe.
Yeah.
And therefore, actually locking yourself into this kind of future is not good. So there you have it. It's what we know. And when we look at asset allocation, right? So where do you want to put your money? Right now, you've got your money in sort of Europe, and people feel comfortable about investing in Europe. But there's going to be a lot of stuff, and there is always a lot of stuff going on around you that you really need to consider.
No, it's I wanted to play my own devil's advocate again, and that is here the accelerating US growth in this. And taking that together with the slide we just looked at, I was asking myself, I made the analogy to Nic before we started actually recording. I thought it's like you have two strong brothers living on an island, or sisters, whatever, yeah? And they're both producing nicely, and one suddenly starts to become ideological, doesn't want to work anymore. Less production. Fine. There is still a need to feed both of them. Yeah? So who is going to make more money out of that? The slacker, I call him, or the other guy who is working hard? Has their own problems, without any doubt. Yeah? But if one of the big industrial nations like Germany actually says, you know what, yeah, we might have no industry anymore, quoting the German Minister for Economics, then you ask yourself, yeah, it absolutely makes sense that the United States, surprising, because if you're a German company, and we have many of those, they go to China, they go to the United States, they go to places where energy costs are not as excessively expensive as they here, and especially if you have a reasonable good educational system, you get the employees who produce your stuff. And China has very bright people, the United States has very bright people. Some countries in Europe have the same situation, more of the conservative persuasion, where the European Union is not their biggest fence, but that is an explanation why the United States comes in and is surprising with their growth. Am I making a wrong analogy here, Nic, or is that an explanation?
Well, I don't think that's wrong. I mean, I think we've been also saying for a while that a lot of the German industry are kind of, how should we say, fed up with how they have to deal with things here and their future, and the stability of energy, and, you know, the certainty of energy prices being stable. And if you were a CEO of a company over here, you would think twice about whether or not to invest money over here in these circumstances. And therefore, I think the only solution is to look elsewhere, whether you make the leap all the way to China or to the States. Right now, I would say the evidence is clear. People would rather not be here and rather be somewhere else.
Here's another nice slide. It's actually the expectations of the consumer in the United States and the reality. On the expectational side, you've heard me several times saying, yes, they're swiping their credit cards up and down. There is no savings, actually. And what's happening? The consumer in the United States says, yeah, bugger off, Wegener. I'm still spending my money because I have positive expectations for the future, and I'm keeping consumerism alive, which is another funnel into the surprising numbers we've seen from the United States. And it's really, we spoke about that, and the quad model actually predicted we should be these sectors long, which we should have been long because we were in a bloody Goldilocks scenario if you just look at the figures. And now actually the figures are confirming the Goldilocks scenario.
Absolutely.
And
Absolutely.
actually, see, I had that in my analysis, the lagging sectors, not with negative performance, but not quite as communication services and high tech, materials and energy, they suddenly start now catching up. People start playing the game, which hasn't performed like we're entering, I don't know, Goldilocks or late stage or whatever. There's still some juice in there. Let's go and buy those.
Yeah, I mean, it's obviously a good thing that inflation is coming down. So that's, very positive. And inflation coming down is a liquidity driver as well. It's not in these numbers here that you're showing on this slide. But inflation coming down is a big boost to the markets. And regarding the consumer, for me, these consumer expectations and things like this are very driven by what's going on in stocks. So they seem to be a lot closer correlated. Stock market's going up, they're very positive. The stock market's going down, they're very negative. What leads what is usually, sentiment drives stock markets. Maybe that's the thing. People just weren't as pessimistic as the people on Twitter. So
this slide, actually, I wanted to ask you because I don't really understand it. It's a LinkedIn feed from the Chief Investment Officer of Swiss Group. Yeah. And I thought it was very interesting. The global liquidity proxy, what has he in there? United States, Euro, Swissies, Japanese yen in US dollars. And what we see here is a huge divergence between the performance of the S&P and liquidity. And we both know it can happen two ways, two persuasions. Either the market as a leading indicator, what a lot of people, including myself, often forget, is pricing in that liquidity will pick up through an enormous Sondervermögen or funneling in, CapEx spending as you see it, or the market is completely overripe for a massive correction. What's your take on this chart, Nic?
Well, firstly, he's left out China. Secondly, it's all in dollars, and there's been a big change in the value of the dollar over that time. So, there's a big question mark. The expert on this thing is a company called Cross Border Capital, Michael Howell, who's the CEO. And on his numbers, global liquidity, which is, what really counts, is it's certainly been flatlining rather than going down. There is a gap, I guess. That gap might be caused by many other things. Like, as I say, I wrote some things down here when I quickly saw this slide. Asian liquidity is increasing now. China, which was actually taking liquidity out, has started to put liquidity back in. The other things which drive liquidity are weaker dollar, lower sort of oil and energy costs. And the other thing, of course, is, I wrote that down here somewhere, is the move index, so volatility. Yeah. So when things like this are all, those are the things that build the whole picture of liquidity. But this is just one of those classic Twitter things where you can show a chart. And if you want to make a point on something, you will find a chart to make that point. But generally, liquidity has been flatlining. I think the equity markets have kind of got ahead of themselves. I've said that before, versus where liquidity is. But you have to understand, why have they got ahead of themselves? I think that's primarily because they've been super excessively bearish, because they've been looking at the wrong things. And now they are just still turning their positions around. They've reached the point of recognition. We talked about that before. And so now people have to move from bearish to bullish. And I think that's where you get this sort of this gap. I don't think it's as wide a gap, the reality, is what is shown by this chart, but there is almost certainly a gap.
So we're clickbaiting humble market makers like myself into discussing these kind of charts.
You know, I don't say I stop because it's quite entertaining, but I do look at these things and I really do wonder. This guy's not selling subscriptions, so you know he doesn't need. He's probably better than that. But normally you see this kind of thing from people who are selling subscriptions, or he's just doing that just to bait people to have a discussion and an intellectual debate about the topic. But yeah, I mean, it's an interesting chart, is all I'd say.
Because the other big explanation I heard, and that was actually interesting, and it is aligning with my experience over the last couple of years, is we discussed that, and the assumption was that the downturn, if it comes, will come out of corporate earnings. What could take corporate earnings down besides selling less? The huge costs of refinancing, which will eat into profits. And this, unfortunately forgotten where I heard it, but I found this chart on my Twitter feed or somewhere. And it was actually, the assumption was that the big corporations were actually front running the market. And if you could remember, just as I do, over the last couple of years, when wasn't there a new issue every day when corporates started loading up on cheap money to put it on their books, whether they needed it or did not need it? So what we see at the moment is, yes, interest rates are rising. The Fed is pumping up the Fed funds rate, but corporates are still very well into cash positions and don't have to refinance before the inevitable wall in 24, 25 will come in, which could be another explanation why I get it at the moment so wrong with expecting this huge recession, because it's simply not the catalyst here to take corporate earnings down in a massive way.
Yeah, I mean, we also spoke about this a few weeks ago. It was another discussion we were having about corporates and the level of interest rates and the impact. You know, why isn't anyone going bankrupt? I think it was a chart on, you know, so many companies going bankrupt now, and the reality is, as you rightly say, interest rates really only matter for those people who leveraged up, right? That'll be private equity, hedge funds, and also the government at the end of the day. So it matters for these people, but for the corporates, if their debt is maturing in 3 years' time and they're cash rich now, they are actually getting 5% on their cash they never got before. Yep. So what a wonderful thing that is. And this chart says, I noticed there's a corporate net interest payment, so net of money that they receive. So the debt that they locked in 3-4 years ago at 1% for 5 years or whatever that might well be, where they're now getting 5% on their cash. And they're saying, well, we don't need to refinance for a year or 2 years. So the problem is not with the corporates. The problem is with the sovereign. The sovereign has the bigger problem, because what you'll find with, if you did a chart for the sovereign, I guess, is that I think there was something from Incrementum. So that Ronnie Stöffler has this In Gold We Trust annual report. And in there, he showed that the US have 45% of their 30 trillion of debt maturing in the next 2 years. That means, you know, 13 trillion has to be refinanced in 2 years. And what is their interest cost going to be? It's not going to be, because they've had this thing at zero for a while. It's now going to be at 5%, 5.25%, 5.5%.
Yeah,
so
that's also
for the government, that's awful.
Isn't that the harbinger of death if we add on the spread, then the credit spread on top of that, when actually these things come to mature and there's refinancing? So I might still, I'm too early with my assumption, which is also wrong, but all these...
Leverage is not good right now. If you are, and as I said, the people who really leveraged themselves up, the hedge funds and the private equity during the time when interest rates were, and real estate projects, when interest rates were exceptionally low, they were always vulnerable to refinancing risk. And that is the risk that when they come to refinance it, either they can't get financing, or the rate is going to be much higher than when they took out the project, whatever that might well be. So, as I say, this sector is particularly vulnerable. The corporates, I don't know. I think the corporates have, higher debt levels, but clearly they're managing them a lot better than, or certainly not better than governments. But I don't think they're as bad, certainly, as these private equity guys who super leverage stuff up.
Yeah. So, positive note, that is a fantastic chart. Source Bloomberg's actually looking to price earning ratios and cash flow per share. If we want to position ourselves, we already touched it a little bit, yeah. If we are the diligent brother who is working hard on the island, what are the next sectors to actually be a bit positive about? What I liked in here is the energy. We discussed that already before, yeah? And I have another slide about the world energy consumption coming on the next slide. Financials, yes, in late stage, you would also assume that financial have a good performance. I like healthcare simply for the reason I've mentioned that many times before. Whether we have a depression or nothing, I'll not stop buying insulin. It's a defensive portfolio, especially when the cash flows are right. Utilities are a bit boring at this interest rate levels. Communications, yes, it's sucked dry, I think. Consumer staples, defensive. Industrials should also. That's what you see picking up at the moment, the lagging sectors we have seen there. Consumer discretionaries and tech and real estate still being on, yeah, we have cash flow galore and our price earnings ratios seem to be cheap. Does that cover your view of the sectors at the moment, Nic?
Yeah, I mean, it all kind of makes sense. I mean, energy, you can understand probably why they have a large cash flow per share, because they haven't been investing in new facilities, new rigs. They've not really got financing for stuff like that because banks wouldn't lend to them. So I think there's been a lack of investment in that sector. And that's why I guess they're throwing off a lot of cash. And also for, just thinking about, where people might be investing in the future. If you think about what's likely to throw up other than, the monetary inflation is going to be, the kind of cost inflation, which is driven by potentially, again, another energy spike. And if you want to protect your portfolio from an inflation, there are many ways to you might want to think about that. And one place might be to invest in energy.
Yep. No, well, actually, by the way, I can make a plug. It will be released on Wednesday. We've mentioned it in our last gray market talk. Murad will show the relative rotation graph to actually give a very good idea how this whole thing works. And so if you have the time and you speak German, check in on Wednesday evening at 1900 hours. It will be released to go into this data. Here's another chart, by the way, about the energy consumption, the sources we need. And I think that makes it so bloody obvious, especially the madness we are driving at the moment in Germany. We have oil, coal, traditional and biomass, well, stable natural gas. And then even the whole nuclear shenanigans, tiny compared to what we have in the carbon sector. What is the need of our planet to keep it going?
Yeah, indeed. Again, you can't avoid making political commentaries on stuff like this. But if I get it right, that as a result of the decisions of the government, that the world is now actually consuming more coal than before, and they had to replace the gas from Russia. So they run around, they buy the gas from other places. So other countries are forced to go and just use coal. But it just goes to show you that this notion of net zero by a certain date. Well, when you look at a chart like this, you say, well, how are you going to do that? And that just means these other energy sources that you've listed here are going to be with us for a very long period of time. And it is naive to run your economy on the basis that you're going to get rid of all of this stuff within the next 30 years. I would say, that's really good luck.
Well, we are not trying to be political here. It's just if you analyze the economic situation, yes, of course, you will have to also make a judgment call. Where does it eventually lead us? And if the numbers show us something, you have to say, like you said, good luck with changing reality into something which it isn't. Well, yeah. That's where we are. Oh, by the way, a little fun statistics. You know, I love to do this kind of stuff all the time. We stopped at 13 up days in the Dow Jones last week, which is very interesting. This chart simply shows how many days in a row we had an up day in the past. And I explain that when I give options classes, always with the gambler's fallacy. There was this one famous, you can find it on the internet, it was in Monaco at their main table. I think they had 17 or 18 times red popping up and people starting betting because they realized, no, it's not going to happen. And I think it finished off at 29 and bankrupted a lot of the gamblers who actually said, no, it has to be black or green now, anything, but not red. And that's what we're seeing at the moment. It's simply this, which gives me a segue also in the volatility segment. Well, I think, at the end of the day, maybe Eugene Farmer is right. And it is sheer coincidence what happens over the longer runs, because we keep on building these beautiful bell curves everywhere. And that is one of the tail events we've just seen in the Dow Jones. So I didn't want to be on the other side of somebody who kept on shorting into the market, believing with digital options or something that we will see a down day the next day. Just a little fun exhibit here. Then also a reason why the market in the US could be where it is. That was an interesting tweet, another source, Bloomberg, March 9th, when pretty much nobody wanted to touch Intel with a barge pole. Yeah, all analysts were of the opinion worst stock ever. Very interesting. 11 sells, and you know as well as I do, maybe not all of our viewers, before an investment bank issues a sell recommendation, hell has to freeze over. You take it down from strong outperform to perform with the market, but a sell is really a little bit of a shocker. And what have we seen? The complete opposite, which brings me to the point, positioning. Nobody was positioned for the situation we're having at the moment in the US markets.
Yeah.
And that leaves us to the point, again, another statistical game, which I love to play as well for this bull market. It simply shows the average gain of a bull market at 114% over an average of 1,011 calendar days, which means for this bull market to get to the average bull, the S&P would need to gain another 68% from current levels, taking it to 7,670 over a period that takes us out to July 2025. Hokum or things that could happen, Nick?
Well, I remember when we were in sometime October last year, where everyone was saying this is the longest bear market ever, therefore, or this it would be the shortest bear market ever if the market goes up from here. There's so many of these stories, I would say, but something we spoke about also a couple of weeks back. I said my view is, you know, the problem is you're going to find, if you're a long-term investor, that you're going to make all your gains in the next 3 years.
Yep.
And then you'll struggle. So you've probably got till about 25, 26, 27 to make your money. And then you probably want to worry about it. But, you know, if you're not invested because you're waiting for better times, well, you know, you could probably miss out the chance to capture the most gains whilst we are in this phase, this euphoric phase that suddenly everyone finds himself in. I sent you something during the week where yet another market analyst, you know, another big bear has, you know, has capitulated and said, maybe the market is going up.
Morgan Stanley surrendered, right?
Yeah, I mean, they were, and I've seen, you know, another couple of famous names who have been doing only Twitter for the and YouTube over the last 6 months that are now suddenly saying, yeah, of course the market's going up. Yeah, we always run long positions anyway with our short positions and stuff like this. But I think that is, you know, half of the bit about what's driving everything is that there were so many people who were so negative. And, you know, you can't blame them. If Wall Street say to you, there's going to be a recession, you believe them. If the Federal Reserve say to you, there's going to be a recession, you're going to believe them. And, you know, you can understand why so many people were kind of protecting themselves unnecessarily throughout this whole time. And now they've got to sort of turn it around. When that ends, you know.
It's one of these other things I've observed over my career is, and I have an example on here, usually at the tail end of these enormous bull runs or bear markets, new product development comes out. So guys like myself or structures are sitting in a room and backtest the shit out of. Market has gone up from bottom left to top right for the last, I don't know how many years. What product looks nicest? And they had something which I hadn't even heard about until I saw this slide, an overnight index, so that it was more profitable to actually go long in the closing and sell in the opening the next day. And you would have make this huge outperformance. At the top chart, you see the overnight index, how it would have looked like from 1993 on till 2022. Massive outperformance. And on iShares Russell 2000, again, the same, the overnight index, fantastic outperformance. If you would held it during the day, not so nice. And then reality sets in. This is obviously, we're cheating a little bit. It's only from January on. Now you can see the Russell and the S&P. Oops, wrong slide. S&P at the bottom of the performance. May that as it be. We all love to do these things and look what you can squeeze out of markets. That was not my point. My point was actually, where are we relative in the system? Where are we relative in the cycle when our structures are sitting there and have to come up with new products, new ideas, what's coming up, because there is this money sloshing around and everybody likes a good idea and a good back test in this. So that was one of the other symbols for me to actually lead to the point which I always lead in. And the excuse is when bears don't have a real excuse anymore, they bring out the seasonalities, which I have in front of me right now. And what we can see here is the seasonality of the VIX against long-term seasonalities, excluding 2008. Obviously, it would have not made such a nice picture if we would have taken VIX spikes of over 80 into this. But that is actually quite interesting because it covers my view a bit, which I mentioned 2 or 3 weeks ago, that we are overdue for a volatility event coming into the market, which is now in this chart. Obviously, right now we're in July, and from July on, the seasonality in the VIX shows the market should come in with higher volatilities, which we see here in this chart. And then there was another interesting slide of the Bank of America Global Research, and especially on the left one is the correlation between interest rates and volatility in the S&P. And you see the orange dots right at the top, July 23. Sorry, this is why on earth would I, excuse me, why would I run around at the moment when my conviction is that, well, recession, I don't want to call it depression, recession could still be on the cards, extremely high interest rates, extremely low volatility in a distribution pattern like this on the left side. In the middle side, we see implied correlation. It's actually what's really happening in the market against what the forecast is. It's also going down to 0.25 at the moment, which means correlation actually only starts at 0.2. When you're at below 0.2, however long the data is, you would need an enormous amount of data to speak of correlation. And on the right side, the final bit is cheapest long-dated S&P hedges since at least 2008. So we are in the volatility window at the moment. I see what's happening at the market, and we all know volatility comes in clusters. When volatility is extremely high, most likely the next day will be also extremely high. If volatility is low, most likely the next day will also be relatively low. And I put out the old charts which I produced for my students, not to teach them on this, but became a very popular bit. I actually did it to not draw the charts on PowerPoint. And what I did here was simply, if you look at the green numbers here, I started with a volatility level of 25, going down to 20, going down to 15, going down to 10, and we're 5% out of the money puts. Market at 100%, and you look at 95% level, which means if you make money by selling optionality, you generate an income. You would have, if market volatility goes down from 25 to 20, sell 1.7 times what you've already sold before to generate the same income stream. If then the market falls to 15, you would have to sell 2.37 times of the previous level in volume to come out with the same premium income. If the market then goes down to a level of 10, Yeah, let's say we are at 13, but I had it here at 10. You would have to sell 5.8 times as much as the previous volatility regime. So the volume goes up, more people keep selling volatility. And in the second window, I took 10% out of the monies. And then you see the numbers are already getting crazy. If the volatility falls from 25 to 20, you would have sell 3 times to have the same premium income. If we then fall another 5 points, you would have to have 7 times or 7.4 times as much as the previous regime. And if the market falls from 15 to 10, you would have to sell 120 times what you need to receive the same premium income. One part of the equation. The other part is the delta in these options. What people tend to forget is delta is relatively low if volatility is relatively low on the out of the money options. When volatility increases, e.g. means we see a spike, then volatility tends to go up, or delta tends to go up to 50-50 level, because everything is possible. If markets slosh up 1,000 points up and down, we've seen that before, which means if you are short the puts, you have to short the underlying, and suddenly you have to short far more of the underlying than you originally anticipated because you haven't done the math properly. And in this scenario, I wrote an article on Macro Hive about that half a year ago or something, with everything being in the 0 days to expiration options. The players or the liquidity volatility providers in the 1 month segment have deteriorated and are now playing around in 0 days to expiration options. What I'm painting here as a picture is simply we are extremely cheap. The market is self-inflicting very low volatilities at the moment. And the risk premium, which is again 5% out of the money put versus a 5% out of the money call, is at extreme low levels, what we can see here on this chart. So it's simply subtraction. You look at the premium you receive for 5% out of the money puts and subtract 5% out of the money calls here. So we are also extremely cheap. And that is, out of my experience, what I've seen many times over. Just before the house burns down, insurance policies are the cheapest you could have here. Obviously, that inspired us already talking about what would you do in a situation like that. And you looked into the longer dated volatility and you said, well, that's one of the cheapest hedge you can possibly have in a long time. And I went a little bit deeper into it. You can actually construct with a bit of cleverness. Yeah, I don't want to scale it down too much. You could actually have a positive carry trade now on a volatility hedge if you set it up the right way. Why wouldn't you do that at the moment? And that's what I don't understand, what's going on at the moment, which these figures represent. Everybody is complete sleepwalking into something. If a tail event happens, it could be really gruesome.
Yeah. Okay. Can I just comment on two slides? So the first slide is we come back to this because I think you're absolutely right with this option and hedging and long dated stuff. And I think that's that does make a lot of sense. But the slide before this, firstly, you had the cyclical pattern of VIX. I mean, if somebody showed me this, I'd say, okay, I do like cycles. I would, this is interesting. I would ask, actually, what does the VIX look like in the presidential cycle? I.e., show me what this looks like every 4 years and don't show me the bits in between. If it looks the same, then, that's quite interesting. But I think we are in the presidential cycle where actually the markets do well ahead of an election, and therefore, it could well be that it's not as wild as is depicted here for the end of the year, but it may well be the same. I don't know. And the next slide, where you talked about interest rates and an implied vol. I mean, would this make sense if you had the notion of what interest rates are about, exactly the opposite? If you had the exact opposite view about what interest rates are about, would you see this chart different? And by that, I'd say interest rates between 2008 or 2007 and right up until the COVID period went basically down to zero, right? They were giving money away, in theory.
Well, let's put it that way. We would then be in the cluster where I would expect it to be. Yeah, the yellow dot would be at the bottom where all the clustering takes place. Well, because okay, fine, that makes sense.
Because that's how people kind of think about it.
Yeah.
But what was going on between 2008 and 2020 was no growth. So there was no growth. Predominantly growth was falling in China. Growth was falling during that time. So, and yet interest rates were really low. And the moment interest rates are really high and we're starting to say, well, actually, there's a bit of growth appearing, that if what Milton Friedman talked about interest rates, he always said things like low interest rates are a sign of tight money and high interest rates are a sign of plentiful money. Yep. And that's actually what we've got. We've put up interest rates at a time when there is money sloshing around, and the money's been sloshing around because we've had this monetary stimulation in 2020-21. So interest rates are higher, and when things were tight between 2008 onwards, interest rates were really low. So think about it the other way around. High interest rates in a growing economy is not a bad thing. They could break the system because the system is now suddenly very fragile because we had low interest rates for far too long, and therefore high interest rates could break it. But I wanted to make those points. I don't know if they are points, but people don't look at it the other way very often.
No, I agree with you. So it's actually the risk premium is just a confirmation of what we saw on the slide here. I recommend everybody look into this. We always do that. We have it on as a rolling hedge, actually, and especially now it's getting very, very cheap to put these trades on. As I said, almost positive carry if you do it a bit cleverly. Who wouldn't want to have that? And that brings me into where you are the expert. You've been a portfolio manager, chief investment officer for over 30 years. That was another interesting topic, the correlation between stocks and bonds on the efficient market frontier, where the whole market was working with since forever, has changed dramatically. What implication would that have, you as a professional, on your asset allocation process? And before you answer the question, one more point is, and I simply don't have the information. If you manage a portfolio discretionary, what do you usually hold as cash positions on the book? If you can talk about usually 10%, 30%, 5%, what is an average number you could give me?
Well, it really does depend on the mandate, right? So how much flexibility you've got. If you are an unconstrained manager, you might, and you were bearish up until now, for example, you might be running 30-40% of cash because that's your job as, let's just say, a macro guy. You've been bearish up till now for your own reasons, and so you're running and probably in addition, you're going all in here. You're going to buy some healthcare because they're a defensive play. So in addition to cash, I'll buy some healthcare. You'd probably want to be short energy because you think it's the end of the world. And all of these trades you'd have on, they'd probably all be highly correlated in my view, but that's not the idea. The idea is you build a portfolio of stories, if you like, that are not correlated. And so therefore the answer is it depends. If you are running a mutual fund, generally people don't expect you to be running large cash positions that they buy the mutual fund because you're invested. If they wanted cash, they'll do that themselves.
That's one of the points, going back to the volatility we had before and the delta, which is rattling me at the moment, because all the ETFs, the Delta One products, the non-managed funds, they are 100% in the stuff they are supposed to hold. Yeah. If we have barely any discretionary managers out there anymore, there's also this lack of cash, which could come into the market when it happens to pick up the cheap stuff, the good stuff. The Apple PEs at 9, not at 30. So this with the efficient frontier here on the screen, that is really something I had to think about because it changes the dynamics we all learned at business school. Pull out the old Markowitz, do your portfolio optimization. I read one of my quants sent me a picture of one big investment bank, which actually said, no, you should be up to 60-70% in cryptos, in Bitcoin.
Yeah, something like that.
Obviously,
Yes,
I know how these machines work, and I thought, yeah, they took the historical data, pressed on optimize for return, and then it spits out, oh yeah, I have 60% in crypto and not in bonds or on equities. The situation given now with this chart in front of us, what would you do, Nic? Where would you position yourself with a conservative mandate?
So we spoke about this the last couple of weeks, where I know that you've been more positive about long dated fixed income because it's a reasonable yield.
Yeah.
We haven't seen these yields for a while, and usually they're not there for a long period of time. Let's lock in, take the money, go home, get 4%, and you're happy with that. For me, if I was running a portfolio, I'd be looking more at the short end of the market. I think there's much more value at the short end of the market as opposed to the long end. So again, when these correlations, it's important to look at what duration we're talking about here as well. So for me, the short end of the markets offer much more value than the long end of the markets. The long end of the markets, there's a real big question mark. And I said before, it's very difficult to judge how the long end of the markets are really going to react going forward. I've got two models which I use for, calculating the fair value of what's the 10-year yield. Both models say they come up around 4% or thereabouts. And, the drivers of this thing are the classic things. Well, where's 3 months money? Or where's the yield in the short end? What's the GDP? What's the inflation? What's the term premium? So you could build models out of this thing, and the yields are about right. So the only reason I'd want to be in the long end of the market is because, I think, suddenly there is a calamity, and I might want to see the long end of the market as being a safe haven. But as we know, the safe haven hasn't worked as a trade, because the more calamitous things are, the less revenue, tax revenue the governments get. And the less tax revenue in a world of sovereign debt bubble, it just means more paper that has to come out. And, very important right now, what's going on is that the US, for example, are issuing a shed load of T-bills. They are issuing and actually steering the yield curve more inverted, or at least that's what they tried to do, is to get money out of, we talked about the reverse repo account, into the T-bills, so that this, without affecting market liquidity, if you like, money comes out of reverse repo and funds the T-bills. And what's happening with the long end of the market? Imagine what happens, and that's at a cost to the Treasury, because the Treasury are paying higher interest on T-bill than they would be if they issued a 10-year note. So imagine now that the reverse repo account goes down to zero. And now where do they borrow money? Now they've got no real incentive to take money out of reverse repo because it's zero. And then they start to issue in the long end of the market. So your bonds investments, if you were looking at the bond investments, would be absolutely, in my view, toast. So there's a greater risk, in my view, of yields in the long end probably edging higher. So there's a great trade to have them down to 3.5 at one point. You want to be involved in that. But beyond that, it's going to be a stretch. And there's probably just as equal a likelihood you get yields at the long end to around 4.5+% towards 5%. In the meantime, you're still getting your 5% on your T-bill or your short-dated instrument in the long. You're not benefiting from any price appreciation in the bond. But at the end of the day, I think I would prefer, if I was a bond looking for where to put the bond part of this allocation, if I was running a balanced portfolio, I think I would still be looking for safety in the fixed income at the short end rather than the long end. And then the stocks, I'd be in Asia, I'd be in, emerging markets and things like this.
Totally agree with you on this one. I would also obviously add as an asset class volatility. Yes, it's usually a negative carry trade. If you just put VIX futures in and keep rolling them, you can lose a lot of money with this strategy. But at the current situation, that would definitely be one part of my portfolio because it seems to work nicer than gold. Gold should, by all rights, when everybody made the inflation forecast, should be at 3,000. Where is it? It's not at 3,000. It's battling to go back above the 2,000 and having an eye on the 1,800 again. So it's one of these things, portfolio optimization. I'm with you, shorter end on the bond side. Equities, bit cautious, but hey, you have to be long, especially in the sectors that keep on, well, catching up now. If we really moving from Goldilocks into late cycle and back and forth between these 2 points in time, but get, for God's sake, volatility in your portfolio. Otherwise, you might end up, and you mentioned it already, in these lost decades. I found this chart very intriguing because obviously whoever prepared it made these nice pattern, gray and white, with always 10-year cycles in between. And that is one of these optical, how would you call it, ocular regressions you put on simply by eyeing it and say, yeah, it's about time that we enter another lost decade because we have so high valuations that the markets now will have to catch up with it. What's the right positioning for that?
Yeah, I mean, it comes two things. When you look at the chart like this, you'd say, well, I mean, it's, the trend is up. So what's the problem? But it's not wrong to invest a certain percentage of your portfolio in protection trades, as you suggested, a small percentage volatility, which could kick in over the next year or two in case. And we know, as I say, the market is very fragile, anything can happen. But nowadays, with debt being so large with sovereigns, they can't afford another lost decade because their tax revenue is very closely linked. If you go onto the Fred website and just look at the tax revenue versus the S&P, they're correlated. So when the stock market goes down, the tax revenue goes down. It's been that way for donkey's years. And, all that shows you is, there seems to be a very close correlation. Greenspan made the point in 2015 in an interview that stock markets need to go up. And in today's world, as I said, I don't think they can afford a lost decade. Therefore, that is why fundamentally, I think they have to continue to keep the system going. That's, they don't have a choice.
Yeah. Oh, for that, by the way, not having a choice, I found the chart I mentioned last week. The most lucrative luxury investments, which are, well, real assets. And I already told that last week, rare whiskey bottles outperformed the S&P, which is interesting. Cars, wine, watches, art, handbags, never outperformed it, but still one of these points. There might not come a better time to splash out for, at the moment, I've mentioned the Rolex market is collapsing for cheap luxury goods, because eventually the Russians will come online again, the Chinese will come online again. They will want to spend their money, and they might not want to spend it on immobile places like houses, but on mobile valuable assets. So that was my last remark for that. Greed and fear, we're still in greedy territory. And before we all get too positive on the market, because the data is confirming it at the moment, I started with a meme, I shall end with a meme. When you're overly optimistic on a Monday morning, always put some volatility in your portfolio. It might not harm you, especially when the time is right to build up some hedges. I think it was terrific to go through this stuff today, Nic. Very, very interesting, especially with the data coming in last week, confirming more your point of view than my point of view. Volatility was a big topic for me this week. I'm definitely looking further into this, especially the dynamics we've seen here are making, well, if you're in the 5th percentile, do you really want to be extremely, let's sell a little bit more volatility? No, come on. Let's build up a position there. If it screws you, it screws you slowly, and that is bearable. I can work with that. If it goes the other way and you have no protection, then it will be very, very nasty and cost a lot of jobs in this scenario. Nic, the famous part of our show, famous last words from Nic.
Have a lovely weekend.
Same from me. I hope you enjoyed that little show. And as I said, next week we are going into the plumbing of how markets worldwide actually work with the different currencies. What do we have to consider, especially in the light of Bank of Japan now changing the game plan? Thank you very much. See you next week. Bye-bye.
See you. Bye-bye.